Bob Hoopsher, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. Calamos Investments and Aksia joined forces this year to launch the Calamos Aksia Alternative Credit and Income Fund. The symbol is CAPIX or CAPIX, an interval fund designed to provide advisors and their clients access to private debt investments, most of them historically only accessible to institutions with the liquidity investors demand. The accessibility concept was nothing new for Calamos. It created one of the first retail liquid alternative funds 3 decades ago. And for private credit, it engaged a partner, Aksia, that has been managing private credit for institutions for almost as long. And for its part, this is Aksia's first foray into advisors and retail clients. Calamos' Bob Behan is here to talk about that partnership and the opportunity set in private credit. Bob is an executive vice president and the chief distribution officer at Calamos. And Bob, I've known you for quite a while now. I've hosted a number of webinars that you've done for our audience. You've had a very prominent career path. Tell me a little bit about your background, how you came to your role now at Calamos, and what that role entails.
Yeah, thanks, Bob. Nice to see you. So currently I lead our distribution efforts at Calamos. When I started in the industry almost 30 years ago, I was trained and came up through the institutional side of the business. And when I got to Calamos, I really transitioned over to the wealth management space, although I do still look after institutional. And for me, it was just clear that I had a passion for bringing institutional type quality asset management services and capabilities into the wealth management space. And this is really just a continuation of what I've been doing for quite some time and I'm very passionate about.
Why did you choose to partner with Aksia?
Yeah, we've been looking at the interval space for quite some time as a leader in liquid alternatives, and felt that if we could find a partner that could bring a specialized expertise to the retail wealth management space, it would be very well served. So we spent a lot of time looking around. We were introduced to Aksia. We were very impressed with their platform and their private credit capabilities, their strong desire to enter the wealth management space, having been in their institutional space for a very long time. And we just felt like it was a great partnership to bring a really high quality private credit manager who sits in the top of the ecosystem, link that with our liquidity and distribution, and have the ability to engage with advisors on the product.
Tell me about CapEx. What is it designed to do? What is the universe of assets in which it can invest?
Yeah, the exciting part about our partnership is CapEx is one of the first funds that really captures the broad spectrum of private credit. When you think about private credit, there's many different definitions, but one that usually comes to mind is direct lending from the corporate side. But there's also distress credit, there's mezzanine, there's real estate, there's specialty finance, and there's specialty situations. So with our partner Aksia, they're able to cover that broad waterfront of those various verticals and bring advisors a one-stop shop type of investment to invest in the full spectrum of private credit, which is really exciting.
What is the benefit of having such a broad spectrum of opportunities from which to choose?
Well, clearly, it's just the ability to access all types of credits in all market cycles is one, but also providing broad diversification across the spectrum of private credit. An advisor or an advisor's client, what looks like an institutional portfolio in each of the various verticals, which is very hard to do unless you have large sums of money for each particular vertical. This product will blend all those together and giving you a real beta, if you will, exposure to the full private credit landscape, which we think, again, is an easy to use package of the interval fund.
What is your allocation now, roughly across various parts of that private credit market? And What is your thinking around where we are now in the credit cycle, and has that caused you to make any adjustments recently?
So right now, the fund is has a liquidity bucket, which we'll talk a little bit more about. 10% that Calamos manages. We also can reasonably expect about 40 to 60% in direct lending, about five or so in mezzanine, 10 to 20 in special sits, real estate and real assets, and specialty finance. The allocations haven't really changed very much since we started the product in about 4 months ago. So we took into account all those various buckets and when we were making the allocation. So right now, everything has been pretty much as we originally projected it back of 6 months ago.
So I know the fund's expenses fall into two broad categories: the management of the fund, and then the leverage that you use. Talk about this stack of expenses that investors will face, and also how the interval mechanism works.
Right. So first, the interval vector. Let me start there. The interval mechanism is a mechanism where investors can buy a semi-liquid type of portfolio with illiquid underlying assets. It has the benefit of being having daily subscriptions through your broker dealer or through your custodial platform, just like a mutual fund. They price on a daily basis. And then on a quarterly basis, you get up to 5% of the fund. I want to emphasize the fund is available for liquidity for redemption purchases. So the fund will invest in very liquid assets, 90+%, level three assets as they're called, but will have liquidity provisions. It also has the ability to use leverage, which is different than, say, a mutual fund or maybe even an ETF. The way the expense stack works is we have a management fee. A management fee in our fund is 125 basis points. There also is the standard fee for accounting, legal, etc. That's 25 basis points is capped. And then the third expense that we would have would be for leverage, which is through a bank loan. The leverage is payable to the bank as for the credit extended. Our fund should have between 10 and 20% leverage, which is, I would say, is a small amount of leverage. And that fee goes directly to the bank. It's important to know that the leverage expense, in our view, is well worth the cost because it is certainly accretive to the fund. If leverage was not accretive, in other words, leverage costs more than the expected returns, we certainly wouldn't have leverage on the product. So if it was unlevered, it would be 150 basis points.
The message that we're hearing from the Fed is higher for longer. What does that mean for private credit?
Yeah, I think what that means is you really need to be careful about underwriting and make sure the businesses that you have can withstand higher interest rates. The way most of the underlying credits work are they are on a variable rate. In other words, they're going to adjust with SOFR. It's usually SOFR plus 5 to 800. So as rates have risen, investors will expect and have been getting much higher rates. However, you just have to be very careful on your underwriting to make sure that if rates stay higher for longer, that the underlying businesses can sustain higher for longer rates, and that's just a very important ingredient.
What are you hearing from advisors in terms of where they're taking their allocations from when they allocate to this fund? Where does it fit in their overall allocation? And how is private credit correlated with other asset classes?
So first off, private credit tends to be very uncorrelated to many asset classes, and even in asset classes that are in the public fixed income market. So there's lots of examples of lower correlation, which is fantastic. And even within the private credit space, whether it's special situations or broadly syndicated loans, there's a lot of lack of correlation, which is why we like a broad portfolio. What we're seeing advisors reallocate out of would be more of the mainstream public credit vehicles, where in private credit you get direct underwriting, you get better docs, you get perhaps better, broader, more diversification. And because of the semi-liquid nature, you're going to get a yield boost, perhaps over, let's say, high yield. So we're seeing it come out of core fixed income and in high yield, with the provision that advisors really have to understand, and I believe they do, and their clients also understand, for the better yields and the better collateral, you do have to give up some liquidity. So in your planning process of your portfolio, um, there has to be a part to say, this is part. I know I can get some limited liquidity, but really you should be thinking about having almost no liquidity in this bucket. Just to say, this is where I set it and I forget it. I'm not going to need this money, and I'm going to really let it build over time. And that's where we see assets coming out of. And typically, what we're seeing is advisors sometimes overvalue liquidity. They have probably way more liquidity in the portfolios than they need, and they're starting to realize that we can give up a little liquidity to get a really nice return stream.
Well, speaking of liquidity, you mentioned earlier the liquidity bucket that Calamos manages. I want to ask about that because these types of funds are often criticized for their investor liquidity or lack of liquidity and for the valuation of the underlying assets. How does CAPEX ensure liquidity and the integrity of its mark to market process?
We have four pillars of liquidity that we believe are very prudent. First is we'll have a bucket, always have a bucket of, call it right now 10%. It may go higher, it may go a little lower depending on our view, but right now it'll be a 10% bucket on investments that we can sell certainly within the quarter to provide for redemption. So that's at least 2 quarters of liquidity. We also have the credit line from the bank that we can tap for liquidity. And then also we'll have staggered maturities within the portfolio so that we'll have over time, we'll have credits coming up that we'll be able to use for liquidity. So we believe the way the fund is structured, that we'll have adequate liquidity up to that 5% level. Also knowing that most investors come into this without thinking I'm going to need liquidity. In terms of valuation, there's many processes that we've put in place that are been looked out by outside experts and outside counsel. We have a very robust operations team and a board overseeing valuation. So we're comfortable on valuations, making sure we adhere to the higher standard, conservative standards, and industry standards at the very base.
Who is this fund right for? What types of clients benefit from adding private credit to their portfolios? And when is it not a good idea for an advisor to add private credit?
The way we've structured our fund, it's for non-accredited investors, and the way you can have a non-accredited fund is that you basically make a deal, which is to say, the fund can have no more than 15% in underlying funds. That is to say, our investment base will be direct deals. So that's very, very, very important. So any investor with $2,500 and an advisor can purchase the fund today. These funds are not available yet on platforms that don't have an advisor. You can buy it through a check and an application through our website, but by and large, they'll be sold through advisors. As for who it's not, for, it is certainly not for anybody that wants immediate liquidity or the view of immediate liquidity or short-term cash or somebody without a very long-term view. I think I think any investor with a fixed income allocation with the ability to withstand some illiquidity can really benefit because the collateral is better and also you get a nice pickup on yield of at least a couple hundred basis points over time for that illiquidity. So no one would rightly in their mind give up liquidity without some sort of compensation for that. And the compensation you get is typically 200 to 300 basis points over a comparable high yield with potentially better underlying credits.
If there's one key takeaway that you would like to leave with our audience of advisors about the diligence that they should perform on a fund like CapEx that invests in private credit that has the interval structure, what would that be?
Yeah, I think you're going to want to get to really understand very deeply the quality of the manager who is sourcing the deals, understand that they have a lot of experience and the research to one by one underwrite these deals. When you're doing credit research, especially in private credit, is very labor intensive. You need to look at each one of these credits, each one of the documentation, and make sure you understand what's in it. And they can be very, very, very complex. So what I would recommend is make sure that you're looking for somebody with the experience, the platform breadth, and that they understand the quality of the manager that you're buying in, and also understand how the fees work. These fees can be very complicated in some of these products, whether they have a performance fee, they don't have a performance fee, how much is the management fee, how much is the cost of leverage. So that's also important. And then also, I would look to a manager who also has the experience in using leverage and knows how to employ leverage in various different products. I think that's also an important.
Well, we'll include some links in the resources section of this podcast where you can learn more about Bob and his team and about the CAPIX fund. There'll be a fact sheet and a brochure for CAPIX. There's a white paper, which is an overview of private credit, and another white paper on CAPIX entitled A Pure Play Institutional Grade Private Credit Portfolio. Bob, is there anything else you'd like to add?
No, thanks, Bob. I appreciate that. And thanks for taking a look at Calamos Aksia Private Credit Fund, symbol CAPIX. Thank you for your time today.
You're very welcome. And thank you for listening to the Gaining Perspective podcast with Bob Hoopsher. Today featuring Bob Behan of Calamos Investments. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on your favorite podcasting service.